Unit 1. Types and characteristics of equity securities. Learning objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 1A. Describe the characteristics of equity securities. Learning Objective 1B. Identify the basic features of common stock. Learning Objective 1C. Recognize the different types of preferred stock. Learning Objective 1D. Describe how incentive stock options differ from non-qualified stock options. Learning Objective 1E. Contrast restricted stock and non-restricted stock. Learning Objective 1. Identify the unique features of American Depositary Receipts, ADRs, and the risks of investing in foreign securities. The Series 65 exam will include approximately 7 questions on the material presented in this unit. Introduction. Because equity is such an important capital market security, the fundamentals that you learn in this unit will lay the groundwork for your success in future units. This unit will cover common stock, preferred stock, and related equity securities. The investment world is divided between owners, stock or equity securities, and lenders, bonds or debt securities. Owning equity in a company is perhaps the most visible and accessible means by which wealth is created. Individual investors become owners of a publicly traded company by buying stock in that company. In so doing, they can participate in the company's growth over time and, in many cases, receive a share of the company's profits in the form of dividends. Lesson 1.1. Equity securities. Learning Objective 1A. Describe the characteristics of equity securities. Characteristics of equity securities. In the simplest terms, a security is an investment that represents either an ownership stake or a debt stake. An investor becomes part owner in a corporation by buying shares of the company's stock. A debt security is usually acquired by buying an issuer's, a corporation or a government, bonds. A debt investment is a loan to the issuer in exchange for interest income, and the promise to repay the loan at a future maturity date. It does not confer ownership, equity, as does the purchase of stock. When investors become owners of a corporation by purchasing stock in that company, they can participate in the company's prosperity by sharing in earnings through the receipt of dividends, and, particularly in the case of common stock, benefit from an increase in the price of the shares. Common stock. Common stock is equity, ownership in a corporation. A company issues stock to raise capital, and investors who buy the stock are buying a share of ownership in the company. The exam will deal with stock that has been issued to the public. That process will be explained in Unit 8. In Unit 7, we will show you that whatever a business owns, its assets, less its creditors' claims, its liabilities, is the net worth of the enterprise and belongs to the owners, its stockholders. Each share of stock entitles its owner to a portion of the company's earnings and dividends and a proportionate vote in major management decisions. Most corporations are organized in such a way that their common stockholders regularly vote for and elect a few individuals to a board of directors to oversee company business. By electing a board of directors, these stockholders have a say in the company's management, but are not involved in the day-to-day details of its operations. Example. If a corporation issues 100 shares of stock, each share represents an identical 1/100th, or 1%, ownership position in the company. An investor who owns 10 shares of stock would own 10% of the company. An investor who owns 50 shares of stock would own 50% of the company. Corporations may issue 2 types of stock, common and preferred. When speaking of stocks, people generally mean common stock. Preferred stock also represents equity, ownership, in a corporation but usually does not have the same voting rights or appreciation potential as common stock. Preferred stock normally pays a fixed dividend, usually quarterly, and has priority claims over common stock. That is, common stockholders cannot receive a dividend until the preferred shareholders have been paid theirs, and in the event the company goes bankrupt, preferred stockholders have a prior claim on any remaining assets. Preferred stock. Preferred stock is an equity security because it represents a class of ownership in the issuing corporation. However, it does share some characteristics with a debt security. As we will learn in the next unit, just as with debt securities, the rate of return on a preferred stock is fixed rather than subject to variation as with common stock. As a result, its price tends to fluctuate with changes in interest rates, rather than with the issuing company's business prospects unless, of course, dramatic changes occur in the company's ability to pay dividends. This concept, known as interest rate or money rate risk, will be covered in the next unit as well as Unit 19. Take note. Unlike common stock, Most preferred stock is non-voting. Therefore, unless stated otherwise in a question, preferred stock doesn't have voting rights. Test topic alert. Like common stock, preferred stock represents ownership in a company, but its price reacts to the market more like a bond because, with its fixed dividend payment, it is price sensitive to interest rate changes. Practice question. Holders of each of the following are creditors except A. Investors owning preferred stock, B. Investment companies owning corporate bonds, C. Corporations owning municipal bonds, D. States owning U.S. government bonds. The answer is A. Remember, all stockholders, even preferred stockholders, not creditors, are owners of a corporation. When it comes to bonds, regardless of the nature of the owner, it is always a debt security, and that makes the owners creditors. Learning Objective 1B, identify the basic features of common stock. Common stock features: growth, capital gains. An increase in the market price of securities is capital appreciation. Historically, owning common stock has provided investors with returns in excess of the inflation rate. For this reason, most investors with a long-term investment horizon have included common stock in their portfolios as a hedge against inflation. Of course, it must be mentioned that stock prices can decline, particularly over the short run. Example: an investor bought shares of RST for $60 per share on January 1, 2022. On December 31, 2022, the shares were worth $90, an increase of 50% in the market price. Income. Many corporations pay regular quarterly cash dividends to stockholders. A company's dividends, in the case of common stock, may increase over time as profitability increases. Dividends, which can be a significant source of income for investors, are a major reason many people invest in stocks. Because stock is an equity security, unlike interest payments on debt, dividends are not obligatory and are declared at the discretion of the company's board of directors. Issuers may also pay stock dividends in additional shares of common stock in the issuing company or property dividends, shares in a subsidiary company or in company products. Example: RST paid a dividend of $2 per share during 2022, which provided the investor with a dividend yield of 3.3%. $2 divided by $60 equals 3.33%, in addition to the $30 price appreciation. Take note: the increase in the price of RST stock in the example above is an unrealized gain until the stock is sold. When the stock is sold, the price increase becomes a realized gain. Capital gains are not taxed until they are realized. Under current tax law, most dividends and long-term capital gains are taxed at a rate not in excess of 15%. Taxation will be covered in more detail in Unit 15. Definition: stock dividend. One option a corporation has is to pay common stockholders a dividend in additional shares of the stock. This saves the cash that would be used in a normal dividend, while giving stockholders something at no cost. For example, if an investor owned 100 shares of the stock and the company declared a 20% stock dividend, that investor would receive 20 additional shares, bringing the total holding up to 120 shares. There are two important facts to know. 1. As a result of the additional shares being distributed, where the company receives no new money, the price of the stock will drop so that the overall value remains the same. Using our numbers from above, if, prior to the distribution, the market price was $48 per share, the investor has $4,800 worth of stock. After the stock dividend is paid, the investor still has $4,800 of stock, but now owns 120 shares. That would make the current market price approximately $40 per share, $4,800 divided by 120. 2. Stock dividends are not taxed when received. As you will learn in Unit 15, they are not taxed until sold and have the effect of reducing the investor's cost basis per share. Do not confuse a stock dividend with a stock split. A split is an accounting process whereby the corporation exchanges new shares for old ones while changing the number of shares outstanding in the marketplace. For example, in a 2-for-1 stock split, the investor now owns twice as many shares worth half as much each. Conceptually, it is the same as changing large bills for small ones. If you had a $20 bill and changed it for two $10 bills, in essence, you've just had a 2-for-1 split. Do you have any more money? No, just two bills worth the same as the previous one. If you changed your $20 bill for four $5 bills, it would be the equivalent of a 4-for-1 split. Rights of stockholders. As mentioned earlier, common stockholders have the right to vote for the corporation's board of directors at the corporation's annual meeting. Stock, whether common or preferred, is freely transferable. Permission of the company is not required to anyone who wants to buy it or receive it as a gift. Without this feature, there would be no stock markets. The owner, or broker-dealer holding the stock, sends the stock certificate to the issuer's transfer agent with instructions to issue a certificate in the new owner's name. The concept is similar to transferring title when you sell a car. Because of the opportunities for fraud, transfer agents, usually large commercial banks, must be registered as such with the Securities and Exchange Commission, SEC, under the Securities Exchange Act of 1934. Shareholders also have the right to receive an audited set of financial statements of the company's performance each year, annual reports. Common but not preferred, stockholders usually have the preemptive right to maintain their proportionate share of ownership in the corporation. The word preempt means to put oneself in front of another. We will have a further discussion on preemptive rights in Unit 4. Practice question. Which of the following statements regarding rights is true? A. Common stockholders would not generally receive preemptive rights. B. Preferred stockholders would not generally receive preemptive rights. C. Both common and preferred stockholders would generally receive preemptive rights. D. Neither common nor preferred stockholders would generally receive preemptive rights. The answer is B. Preferred stockholders have no right to maintain a percentage of ownership. When new shares are issued, no preemptive rights. However, they do receive preference in dividend payment and company liquidation. TST2PICA alert. Prior to a vote or a payment of dividend, the company establishes a record date. This is the date by which an investor must be an owner of record, shown as an owner on the company's records, in order to vote or receive the announced dividend. Limited liability. One of the most important features of equity ownership, common stock or preferred stock, is limited liability. In the event of the bankruptcy of a corporation, when corporate assets are not adequate to meet corporate obligations, the stockholder's personal assets are not at risk. One cannot be forced to sell any personal assets to help pay the debts of the business. An individual investing $5,000 in the stock, common or preferred, of a corporation that goes bankrupt may lose the entire $5,000 if the company is not salvaged, but will not be forced to pay out any more money to take care of the corporation's debts. That investor is personally at risk only for the amount that was invested. This is different from a business organized as a sole proprietorship or partnership, where the owner's personal assets are placed at risk should the business not be able to pay off its obligations. This concept will be discussed later in Unit 16. Liquidity. In almost all cases, shares of common and preferred stock are freely transferable. That means that shareholders do not need the permission of the issuer or anyone else in order to sell their stock in the open market. This is especially true in the case of shares traded on the major stock exchanges. One exception is restricted stock, covered shortly, where sales are contingent upon meeting the requirements of SEC Rule 144. Benefits and risks of owning common stock. Regardless of their expectations, investors have no assurances that they will receive the returns they expect from their investments, so the risks must be balanced against the rewards. Take note. In owning common equity, the investor stands to lose current income through dividend reduction or suspension, as well as capital loss, should the market price decline. In return, however, the shareholder has limited liability. That is, the liability is limited to the amount invested and theoretically unlimited potential for future price appreciation and or dividend growth. In summation, why would you include common stock in a client's portfolio? Potential capital appreciation, income from dividends, and hedge against inflation. By including common stock in a portfolio, the client would be incurring the following risks. Market risk. The chance that a stock will decline in price is one risk of owning common stock, known as market risk. A stock's price fluctuates daily as perceptions of the company's business prospects change and influence the actions of buyers and sellers. Investors have no assurance whatsoever that they will be able to recoup the investment in a stock at any time. Business risk. A risk of common stock ownership is the possibility of a decline in the company's earnings. This could lead to a reduction or even elimination of the dividend. Low priority at dissolution. If a company enters bankruptcy, the holders of its bonds and preferred stock have priority over common stockholders. A company's debt and preferred shares are considered senior securities. Common stockholders have residual rights to corporate assets upon dissolution. Practice question. Limited liability regarding ownership in a U.S. corporation means all of the following except: A. Investors might lose more than the amount of their investment. B. Investors might lose their investment. C. Creditors of the corporation cannot seek relief from the shareholders. D. Investors are not liable to the full extent of their personal property. The answer is A. An advantage of owning stock is that an investor's liability is limited to the amount of money invested when the stock was purchased. Learning Object V1C. Recognize the different types of preferred stock. There are several different types of preferred stock, starting with straight preferred, think of plain vanilla, and expanding depending on which and how many adjectives we use to describe the security. However, all maintain preference over common stock. Remember, preferred stock is an equity security, and, just as with common stock, dividends are paid at the discretion of the board of directors. Because, with one exception noted below, those dividends are fixed, many investment professionals consider this a fixed income investment for asset allocation purposes. Those dividends are either a stated amount, $6 preferred, or a percentage or par value, $100 par, 6% preferred. What is special about preferred stock is that a dividend can never be paid to the common stockholders unless the preferred is satisfied first. Preferred stock may have one or more of the following characteristics: straight, non-cumulative. Straight preferred stock has no special features beyond the stated dividend payment. Missed dividends are not paid to the stockholder. Cumulative preferred. Cumulative preferred stock accrues payments to its shareholders in the event dividends are reduced or suspended. Dividends due cumulative preferred stock accumulate on the company's books until the corporation's board of directors decides to pay them. When the company resumes dividend payments, cumulative preferred stockholders receive current dividends, plus the total accumulated dividends, dividends in arrears, before any dividends may be distributed to common stockholders. Example: in 2016, RST Corp. had both common stock and cumulative preferred stock outstanding. For the year, the common stock paid total dividends of $1, and the total preferred dividend was $2. Because of financial difficulties, the company stopped paying dividends after 2016. Having resolved its problems in 2021, the company resumed dividend payments and paid the cumulative preferred holders an $8 dividend for the arrearage in years 2017, 2018, 2019, and 2020 plus the current years, 2021, $2 dividend before paying any dividends to the common stockholders. Test topic alert. Because of this unique feature found only with cumulative preferred stock, an investor seeking steady income would find this to be the most suitable of the different types of preferred stock. Callable preferred. Corporations often issue callable or redeemable preferred stock, which a company can buy back from investors at a stated price after a specified date. The right to call the stock allows the company to replace a relatively high fixed dividend obligation with a lower one when the cost of money has gone down. This is similar to refinancing a mortgage. When a corporation calls a preferred stock, dividend payments cease on the call date. In return for the call privilege, the corporation may pay a premium exceeding the stock's par value at the call, such as $103 for a $100 par value stock. Issuing the call can create a problem for your client, who purchased callable preferred shares issued at a time when market conditions dictated relatively high dividend rates. If the cost of new money comes down, the company will call in the preferred and the investor will now have to reinvest the proceeds at a lower rate. This is an example of reinvestment risk. Having the call price at a premium over par is one way to compensate for this additional risk and inconvenience. Another is that the dividend rate on callable preferred stock is generally a bit higher than other preferred stock issued by the corporation. Convertible preferred. A preferred stock is convertible if the owner can exchange the shares for a fixed number of shares of common stock of the issuing corporation. Take note. Because the value of a convertible preferred stock is linked to the value of a common stock, the convertible's preferred price tends to fluctuate in line with that of the common. Convertible preferred is generally issued with a lower stated dividend rate than non-convertible preferred of the same quality, because the investor may have the opportunity to convert to common shares and enjoy greater capital gain potential. This feature can have the effect of reducing the interest rate risk. The concept of a convertible security will be discussed in greater detail later in the next unit when we cover convertible bonds. Adjustable rate preferred. Some preferred stocks are issued with adjustable or variable dividend rates. Such dividends are usually tied to the rates of other interest rate benchmarks, such as Treasury bills and money market rates, and can be adjusted as often as monthly. The decision as to the frequency of adjustment is that of the issuing corporation and is not a testable topic. Because the payment adjusts to current interest rates, the price of the stock remains relatively stable. This adjustability tends to reduce interest rate risk when compared to other preferred shares. Test topic alert. For investors looking for fixed income through preferred stocks, adjustable rate would be their least appropriate choice because the dividend will likely fluctuate. Take note. A preferred stock could be cumulative and callable and convertible, or any combination of these adjectives. If none are listed, it is just a straight preferred. Test topic alert. Because the primary objective met by investing in preferred stock is income, when analyzing a specific preferred stock, the most important determination should be the ability of the company to meet its dividend payments. Practice question. An investor who has purchased preferred stock with the goal of receiving steady quarterly income would be most interested in the A seniority of the stock compared to other securities. B ability of the company to continue paying the stated dividend. C voting power of the shares. D par value of the shares. The answer is B. Investors in preferred stock with the goal of income are most concerned that the company will be able to sustain the dividend, making choice B the correct answer. For exam purposes, all preferred stock is non-voting, and it makes no difference if the par value is $10, $25, or $100, because the dividend is fixed as a percentage return. The fact that the preferred stock has seniority over the common is important, but that concept is included in the ability of the company to pay its dividend. Benefits and risks of owning preferred stock. In summation, why would you include preferred stock in a client's portfolio? Fixed income from dividends, prior claim ahead of common stock, and convertible preferred sacrifices income in exchange for potential appreciation. When investing in preferred stock, the client would be incurring the following risks. Market risk. In an economic downturn, fear of an inability to maintain the dividend will cause the price to drop. Possible loss of purchasing power. Interest rate, money rate, risk, and business difficulties leading to possible reduction or elimination of the dividend, and even bankruptcy leading to loss of principal. Take note. Although it is generally regarded as a fixed income investment, preferred stock, unlike debt securities, usually has no preset date at which it matures and no scheduled redemption date. Preferred stock is thus a perpetual security. Knowledge check 1.1. Question 1. Owners of a corporation's equity securities. A. Are always assured dividends if the company is profitable. B. Are creditors of the corporation. C. Have limited liability. D. Have the right to vote their shares. The correct answer is C. One of the benefits of being an owner of a corporation's equity securities is limited liability. That means, no matter what happens to the company's fortunes, the investor can never lose more than the original investment. The company's creditors cannot come after the stockholders and make a claim. Although owners of common stock always have voting rights, owners of preferred stock, the other equity security, almost never do. Dividends are not guaranteed, and even if the company shows a large profit, there is no obligation to make a dividend payment. Remember, as holder of a company's equity securities, one is an owner, not a creditor. Question 2. Among the benefits of owning common stock are Roman numeral 1. Historical hedging against inflation. Roman numeral 2. Voting rights. Roman numeral 3. Access as owners to information about corporate earnings before the general public. Roman numeral 4. Dividends. A. 1 and 2. B. 1, 2, and 4. C. 2 and 4. D. 1, 2, 3, and 4. The correct answer is B. One does not have access to insider information solely by becoming a shareholder. Even if one did receive material non-public information, such as prior access to earnings, no benefit may be received from that information. All of the other choices are among the reasons to purchase common stock. Question 3. A company that has issued cumulative preferred stock. A. Pays past and current preferred dividends before paying dividends on common stock. B. Pays the preferred dividend before paying the coupons due on its outstanding bonds. C. Pays the current dividends on the preferred, but not the past dividends on the preferred, before paying a dividend on the common. D forces conversion of the preferred that is trading at a discount to par, thereby eliminating the need to pay past due dividends. The correct answer is A. The concept behind cumulative preferred stock is that dividends in arrears accumulate and must be paid, along with the current year's dividend, before anything can be paid to common stockholders. Bond interest is always paid before dividends.